Right. Well, thank you for showing up today. I really appreciate it. It means a lot that you want to come in and learn, get some information on this. This is totally cool. So let me start the slideshow here. So yeah, that's me. Thanks for coming. I appreciate it. But so today, I just want to talk about with all the stuff that's happening right now. I think it's the job is to come out with payment options because people are scared, right? So that's the idea. Like people need you just don't look at the rate and say, and here's the payment, and that's that. We have to be more creative in this environment, especially what's going on, and that's what I specialize in, right? And so the cool part is there's no tariffs on mortgages. So I think we're good there. We don't have to worry about that, which is great. But I just wanted to show you what's happening in the marketplace in terms of interest rates. And the challenge that you run into in these times of volatility, the reason why it's volatile because it's changing so fast, right? So the last one we had was a pretty significant run up back here in October. We were down and got lower for literally like 2 weeks, and then it just shot back up. So anyone who's thinking about trying to refinance down here, well, let's see what's going to happen. Maybe the rates are going to go lower, right? And yeah, maybe they will. Okay, great. Let's just see what happens. And then it just went right back up. So, and we're kind of the same situation now, but it's the opposite, right? So now you can see before the tariffs hit, boom, then it came down, and then all stuff started hitting the fan, right? They're like, hey, what's going to happen? What's all these other things? And so everyone's worried about recession, other stuff. And when people are nervous and things change, they don't do anything. And so you can see how interesting, look how fast that went. I mean, that's just, I mean, really, within 3 days, you're like, hey, rates down to, almost 6.5. Now we're at seven, a little, as a Friday, we were at 7.25.
That was the Friday before.
It's Friday, yeah. It's a little bit lower. I'll talk about it tomorrow. But that's fast, right? So I'm calling people saying, hey, I know we're quoting you this, but here's the interest rate over here, right? And so you're trying not to be the bad person. I'm just trying to be, I went them like, I found this house and I was like, whoa, I forgot to tell you the rates have gone up, a half point. You know what I mean? So those are the things, especially if you talk to me here, I'm a great guy. You talk to me here, I'm not so great. It's just a matter of the timing when you talk. So, but that's what's been kind of going on. So these rates have been shooting up because of the uncertainty of things. Now, the other thing too that's making it a little more challenging is that the spread on top of this is going up. So when people are uncertain, so when the rates came down here, I tried to call people maybe to refinance, but the challenge is that the spread or the margin on top of this gets bigger because of the uncertainty. If the lenders are going to get money, they have to borrow the money from somewhere. And if they're unsure what's going to happen in the market, they're not going to issue rock bottom rate. They're going to have a margin that the float on top of it is going to be higher. And so that's what you're seeing now. These margins have gotten higher, which means that some of these rates haven't gotten as low or a little bit higher than they would be before because they're just not sure what's going on. So when we're in this type of a market, there's volatility, there's uncertainty, there's complexity, and there's ambiguity, right? And so that's what everyone feels. I'm sure over the weekend you talk to buyers and they're like, hey, if I listed my house 2 weeks ago, and you got it on the market and sold, great. If you have your house listed this past week, it's got to be a little bit challenging of a thing. As a seller, you're like, oh my God, what's going on? I don't know. And you're watching the news and all this other stuff, and it just creates volatility, uncertainty, complexity, and people stop. I mean, buyers that I've talked to, so I just wanted to see what happens. I'm not sure. But I know from my perspective that this is a great time to buy because if everyone's unsure, you're going to get deals that you wouldn't have gotten before. So, but how do I fight that? How do I not get sucked in that bad mindset, right? So that's what people feel. And then so my thing is to try to combat that. You have to vision, understanding, clarity, and agility. And so the vision part of it to me is like, hey, here's how home values have gone up since 1970, since 1942. Home values have gone all the way up, except a couple years in 2007, 2000, the Great Recession. So this is one piece how I combat that. You get in the game because right now, 5 years from now, if you didn't buy, you're going to be out, you're going to be out these gains. So that's the first thing I go through. And we talk about the magic rates closer to 5.5%, right? So when people get to 5.5%, they feel like, hey, I have these lower rates. I'm thinking about I can move somewhere. The payments are tolerable. That's what in people's mindset, what they're thinking. Once we get to 5.5%, I showed you in that slide when it went down a little bit, things were moving for like 2 weeks and then it shot back up. But that's kind of that's where you need to be. And the question is, how do we get rates closer to that magic rate. And so my job is to create payment affordability, right? That's what I want to do and illustrate to you guys how that works. And the more you're confident with it and understand it, then you can explain it to your seller, you can explain it to your buyer, and they can really understand that too, right? So that's the idea. So when I talk about rates, I talk about where is the zero today, right? And basically the zero means what's the cost of getting a loan? So the cost of getting the loan is where we borrow our money, we make our profit and everything else. What's that rate where there's no additional cost to get that particular interest rate? And I call it where's the zero. So this zero fluctuates up and down all over the place, depending on market conditions and everything else. So if you want to, if to say the rate, the zero today is at 4.5%, you could pay additional fees if you want to get the rate down to 1%. You just have to pay additional fee for that lower rate. It's going to cost our company to get money that's cheaper, but it's going to cost more. So then we pass it on to the buyer. Yeah. And conversely, if you want to take a higher rate, I can give you credit towards your closing costs. I was talking to someone the other day, like, I'm not going to be in a house more than 3 years. So I'm going to go ahead and we'll get you a higher rate. Well, I want the higher rate. Yeah, but I can save you $10,000 on closing costs. It'll definitely be better than that than paying a couple $100 a month for the next 2 years. So those are the kinds of things that we look at. But that's the concept. Anything lower rate, where above the zero, then you have to pay extra fees. If it's lower than that, then you want to, you'll get a seller credit or a lender credit from me. Okay. Make sense? So where's the zero today history, right? So the zero was at 3.25 in 2021, which is pretty good. So, and then in March 22, that's supposed to be March of 2022, it was around 4.5%. And then today that zero is all the way around, 7.25. Okay. So if you want to get that lower rate, it's just going to cost you more to get it. Okay. But the question is, when you ask what is the interest rate today, you're saying what's the cost of a loan with no additional fees? Okay. Got that? There. Okay. So let me show you how we get to that magic rate of 5.5%. Okay. So today is 7.25%. A point or the additional fees is a percentage of the loan amount to get the cost. So in other words, the cost of the point is a percentage of the loan amount. So for example, if we were looking at today, did I not do that? Back. Okay. But yeah, I was using a payment of like 760 as a loan amount in this scenario. Okay. And I'll show you the next one. But anyhow, so it's 7.25% at 0 points, right? And if you wanted to get 7%, it'd cost you 0.875 or additional $6,650 to get the rate down lower. Okay. It's 0.875 of your loan amount. And I was using an $800,000 purchase price with putting 5% down. So it gets you 760. So if you want to, so in other words, you can see how it just goes. There's not like a rhyme or reason to it. So sometimes it's not like, hey, for every quarter point, it's a certain percentage amount. It's just kind of what's going on. And these are slightly inflated a little bit because of that margin I was telling you about. So because of the uncertainty sometimes of the market, these point structures might be slightly higher than they historically would be. But again, 7.25 at no points. I could say, look, I really want 6.5%. It'll cost me 2.75% or $20,000 additional dollars to get that rate. Okay. And then if you want to get that magic rate down to 5.5, it'll cost you $53,000. Okay. That's probably a non-starter. So that's the challenge. When rates fluctuate and the closer we get to this 5.5, you get it down to the 5.5, will fluctuate. And as of Friday, it would cost you $52,000.
So question, so if you're selling a home, more than likely, that's where you'll have that $52,000 to put into the next home, right?
It could be, yeah.
And that's where you're trying to get away from capital gains and all that, all the other things, right?
We'll explain it again, sorry.
Well, when you sell a home, have a profit, do you have pay capital gains or other taxes on that?
Yeah.
If you reinvest it into a new home, you pay that down off of the profit from that.
Well, I think you still have to pay it. You can't reinvest into a new home.
Okay.
Yeah, it's not like an investment property and different things. They give you ways around it, but if I sell my house, I make the money and I buy another house, I still got to pay like capital gains. Okay. But yeah, so that's kind of the idea. And so I guess your point is that if I'm trying to sell my house or I'm buying a house and I know the magic rate's 5.5, whatever, how can I make it closer to that, right? And that's kind of the idea. That's how you create that. It's kind of a game. How do I figure out, or what's the math problem? How do I can figure it out to get it there? So let me show you this. And the next slide is, here's what it is if the rate started off at 6.5%. So maybe that zero is at 6.5%, like it was a couple weeks ago, right? Now the cost to get it down to 5,500 is only 28,500 or 23,000 or close to it, 28,500. So you can see how much that just changes it so fast, right? So again, we kind of play around with these, and so it's just a matter of what we can do and how do we do that. So if you pay these points, these are like permanent buy down. So you pay the fee for the life of the loan. You pay this fee for the life of the loan. Your interest rate would be here. Okay. So there's a couple different ways that we can look at it. So you've got like a temporary buy down, and you also have a permanent buy down. So these are permanent buy downs. And so I'll explain the temporary buy down, but the thing is with the permanent buy down, it's for the life of the loan, it's a one-time fee. So if you pay this fee of 28,000 and all of a sudden 3 weeks later the interest rate dropped to 5.5%, right? You kind of lost. Or hey, I gotta move, right? So, but the thing is, I guess in my mind, how do I say this? Most of the kind of not economists, but most of the people that we talk to, and the head person in our company right now says the interest rate when it finally settles down should be around 5.5%. Okay, so it's funny how it's kind of like that magic number. But if we get down to 5.5%, we're not going to get much lower than that, right? You might have periods where it might get slightly lower, but realistically, we're not seeing 4%, we're not seeing 3%, we're not seeing any of that unless there's some kind of black swan event that'll happen. I mean, I've been in the business since 1999, 2000. So we had the tech boom or the tech fallout after 9/11. We had the Great Recession, 2008. Then we had COVID. Those are 3 ones. And this one right now is different because I think it's almost man-made. You know what I mean? It's not like there's some systematic problem with our economy that's causing this. So I think this will get straightened out at some point. We're just going through a rough patch. But I think ultimately, if the interest rates can get down to 5.5%, and we get closer to the 5.5% range from here, or close to it. Let me go back, sorry. This one over here. If we get close to it, 23,000 or 20 grand's not terrible. You know what I mean? That's in striking distance. Once this gets to striking distance, maybe a permanent buy down does work. Okay. Because part of me is thinking like, hey, if interest rates are always going to come down, we'll do a temporary thing and we'll refi. But what happens if the rate doesn't come down? And if the rate's really going to get to 5.5%, and it takes us 3 years to get there, maybe you're better off getting it now than waiting, and trying to do the refinance. So I guess my point is the closer we get this down to here and this becomes manageable, then maybe the permanent buy down makes sense. Okay. But if we're where we are today, permanent buy down is tough, right? That's hard. So that's why we go into that temporary buy down program. Okay. So I think if we're further away from the 5.5, we look at temporary buy downs. The closer we are to that, or closer we are to that 5.5, maybe the permanent buy down makes sense. Okay. And so then you're like, well, what are these different buy downs? So a temporary buy down is you have a lower rate for the first 2 years, and the rate is reduced by 2% in year 1 and 1% in year 2. Okay. You qualify on the actual payment. You're not qualifying you on the 2% reduction. Okay? Your rate adjusts on the year 3, and your mortgage payment stays the same for the life of the loan. The cost of the buy down, or the fee for the buy down, is the difference between the fixed rate of the loan and the temporary buy down. And I'll explain that to you. And then the prepaid difference. So in other words, a permanent buy down is you pay a fee and that's it. This is you're paying a fee to have lower payments for the first couple of years. Okay. So on your sheets, I'm going to show you this. This is temporary buy down. So the back of this. Okay. Because I think if you understand, the more you understand and get it, it's easy to talk to somebody about it, especially maybe your sellers too, if you have a listing. So the idea of what I'm saying is that, how do I show you? So if the sales price is $800,000, okay, and we do 5% down, your loan amount is $760. Make sense? Okay. And say the interest rate is 7.25%. So your payment without taxes, everything else is $5,184. Okay. So on a temporary buy down, a 2-1 buy down, which means for the first year, your interest rate would be 2% lower than the 7.25. So it'd be 5.5, 5.25, okay? The payment at 5.25 is $41.97 versus $51.84. Or a difference of $988. So if I do a temporary buy down, for that first year, my payment is $988 and $988 less, or $41.97. But over the cost of the year, by paying that for 12 months, it's $11,853. Make sense? So the cost of the temporary buy down is the difference between the payment and the buy down payment. $998 times 12. After the first year, your rate will go to 6.5% in that second year. Payments $46.79. The difference is $505 or $6,000 a year. So the difference between the cost of both of these years is $17,914. So it costs you basically 18 grand to do this program. Okay,
So essentially, all you're doing is prepaying the interest.
got it.
Okay.
So the
Not
cool
really.
part about this, no additional fee, right? So it's not like the other one, you're paying a fee to get that low rate for a long period of time. This one is no additional fee. You're not paying a fee above and beyond things. The cost of it is the difference between what you're paying. So again, if I would have, so it'll cost you 17,000. So basically what you're doing is you're putting 18,000 bucks in an escrow account. And every month, when you make your payment of $41.97, they'll take $988 from this bucket and make the total payment. Right? So every month you make this payment, this bucket goes lower. Oh, sorry, this bucket goes lower and lower and lower until eventually it goes to zero, right? Because after 2 years. So you're like, hey, that sounds great. I don't know if I want to do it for myself. What's the benefit I'm getting of it? I could put that money in a savings account now and still do the same thing. The benefit is that if you get the seller to pay for it, or you get the lender to pay for it, right? So if you get it paid for by the seller, it's 18 grand. So you can take 18 grand and try to get the seller to pay for it, and then you can really significantly lower your payments. If rates are at 5.5, and all of a sudden a year later or 2 years later, interest rates go to 5.5, right? You're like, hey, my 30-year fixed payment is this. I can get down to 5.5. Well, let's do that. Any money left in this bucket reduces the principal balance of the loan. So you never lose it. Either you use it or you don't. But you can never lose it. Okay. So the cool part is that, hey, I'm a buyer. I'm nervous. I've got all these things going on. Aaron, you're telling me it's a good time to buy, but rate's 7.25%. Well, if we do a temporary buy down for the next 2 years, we really can get your payment down by almost, $980 or 500, significantly different, right? So if we do it right, we reduce the interest rate from 7.25 to 5.25, 6.25. Then maybe the next 2 years, if rates come down, we refinance into a 30-year fix. If there's money left in this account, we reduce your loan balance by what's left in this account. Kind of cool. But again, your rate is always this. You qualify on this rate, not this rate. Okay. So then you can say, hey, look, seller, hey, I need some help. I really want to buy your house. I'm afraid about interest rates going up, but man, if I can get it in for here, but I'm only doing 5% down. I don't have the 19,000 or 18,000. Maybe I reduce the purchase, seller, can you help me with that? And that's kind of the idea. Okay. That's one way to create the payment affordability. The other one is the permanent buy down, a one-time fee paid to reduce the interest rate for the life of the loan. 7.25%, that's on the backside of this one. So 7.25%, 0 points. If I do 7%, it'll cost me, so in this one, it's $760,000 the loan amount. And I'm taking 0.875% times the loan amount is the cost of the loan, is the cost of the buy down. So I can save $128 a month if I want to do that. Okay, great. I'll go break even in 4.32 years. In other words, the difference between this and this is 128. The cost is 6,650. I take the cost divided by savings, and that tells me how much I'm going to save per month or for the year. So if I keep this loan for more than 4.32 years, I'm better off taking the lower rate. And the converse is true, right? So if I take a higher rate and you give me money, then as long as I keep it in the next 4 years, I pay it off in 4 years, I'm good, better off. But you can see getting all the way down to 6.375 will cost you 23,000. And I'll break even in 4.47 years. So 23,000 is 3.125% of 760. That's the cost. And the way I qualify will be based upon this rate, not the temporary rate. Or it's the full rate. You're just paying a full buy down. So you're qualified on this. That's what everyone does. That's plain Jane stuff. When interest rates get wonky in the way that we're doing, the temporary buy down has a little more teeth to it. It makes it a little more impactful. But again, I think this is good if we're closer to that 5.5% range, where it's not costing us 53,000. Maybe the temporary buy down is better when you're at the 7.25, and then we can hopefully rates come down. Questions on this? A lot of stuff. Does that kind of make sense though? Basically, the concept I want you to get is that there's a fee, permanent fee for this. That's what you pay. The other one, the temporary buy down. Sorry. The temporary buy down is only temporary. The cost of the temporary buy down is the difference between what you're paying and what the artificial payment is. Okay. But this is not additional fees on top of anything. It's just the cost is the difference between what the payment would be and the artificial payment. So I like this because there's no additional cost. Even it's just, you're not paying for it.
So in a scenario, volatile economy right now, house might not be selling, right?
Yep.
Difficulty, so seller, I have a buyer, buyer wants to buy the house. If you do this program for us, one of these programs, put that money towards the loan, then I'll offer for this amount, assuming the house is gonna appraise at a good enough value.
Yeah, that's creating payment affordability. I mean, it sounds kind of basic, but that's it. I mean, my idea is like, I know people come in and they're freaking out because the market and everything else. And I'm like, I don't want to buy because I think there's a slide issue at the beginning of the year. It was from NAR. Sorry, it was from NAR. And it said, top reason why no one wants to buy a house, interest rates are too high. Okay. Or and the second one was the home values too high. They're waiting for home values to go down and interest rates to go down. You can't have, but it doesn't work. So the idea is, how do I create this payment affordability and that, and really educate and be a consultant? They can kind of figure out what buyers want to do, right? But that's kind of the idea. When they come to me and say, look, I don't like these payments. Well, neither do I. Let's see if we can lower it down. So that's the cost. So that's it. So on the buy side, that's the payment affordability program, right? We can look at these two programs, see if it makes sense. If the home has been sitting on the market for a week or two, you might have more options. If it's just coming out of the gate, you're probably not going to get it. But if homes are going to sit for a little bit longer because of the uncertainty that's going on, this might be a good opportunity. Okay. So that's on the buy side of things. So I try to make this as complicated as possible for you guys. So here's the payment affordability program on the sell side. Okay. So I have this house at $800,000. And the sales price is $780,000, and I'm doing 5%. And so it's $800,000. $5,185 is my payment. Okay, with no points in knowledge. The seller can come in and say, look, or the buyer can come in and say, look, I want a $20,000 price reduction. Because that's what most people negotiate is on price, right? So I do a $20,000 price reduction. My loan amount $741. And now I go from $5,185 to $5,055. So it's like $136. Okay. And so on this line, what I'm showing you is that for every $20,000 in reduction in price of the house, it'll save you $136 per month. So just to kind of get an idea. So if I say, look, I want this house at $100,000, I want to offer you $20,000 less, the buyer saves $136 a month. Yay. That's good. But there might be something better. If I do a permanent buy down and take the $20,000, right? So offer $800,000 and I want the permanent buy down, then I can do this and it costs me 3.125 or $23,500. Right. So for an extra $3,000, I could see if the seller paid the 20 grand, right? And now I've got my payment, the 4741 versus 5185. That's significant. That's savings. Okay. Make sense? Or I could do the other thing is do the temporary buy down. Same thing. I can get to 5.25% for that first year. Right, 41.97, ridiculously lower price, almost $1,000 cheaper. And the cost of the temporary buy down is only 17,914. So as a buyer, I could say, look, how do I want to use that 20 grand if I want to offer that? And those are the strategies that I'll work with the buyer and work with you if we're representing the buyer, right? How do you want to do this? Hey, the price could be here. We could use it. Hey, seller, hey, buyer, what about these other options? Let's see if you, because everyone's looking, they look at price, but you're also looking at what your payment is each month, right? It's like going to a car dealership, you know, the first thing I ask you is like, what's your payment rate? And with the payment, they don't really know about the price. Here, it's a home, you know it's going to keep going up in value at some point, but everyone's focused on price or on payment versus the actual price of the house. $136 a month is not going to move the needle on people. If I say I can save you $1,000 a month, that moves the needle. That makes sense? Eric, I'm throwing a lot at you, man. There's a fire hose.
I'm following you on the, I kind of understand more of
Yeah.
the permanent one.
The temporary, yeah,
I'm a little confused, so the 17.
for sure, that's why we're here, all good.
So that's what you pay up front to get that.
Well, the
second year.
cost, so this cost is the difference between 7.25%
Yeah,
and 5.25. So it's $988 times 12 equals that.
so you pay that 17 up front to get the 5.
Correct. So in other words, so what will happen? This money sits on the account. So once the loan is closed, almost 18,000 will sit with the loan. So you get this loan and 18,000 sits next to it. And every month, when you make that payment of 41.97, they'll take 988 from that bucket. And this, after the first month, this will go to 17,000, $125. So it just works its way down until there's nothing left. Once there's nothing left in this bucket, the payment will go back up to 5180.
But that has to be paid by the seller.
Okay, yeah,
Well, and this is what I'm saying. This, regardless of who pays for it, the concept is that that's how it works. So we draw from this bucket until it's zero. This 17,000, this 18,000 or 18,000 is in addition to your to the funds to close. Your funds to close will be increased by $18,000. Then you got to figure who's going to pay for the 18,000.
Hopefully you can get your seller to pay for one.
Yeah, we're not going to do this until we have a good. Yeah, you're not, like I said, it's not the first. It's on the market for a week, and we're doing that.
and that's just an overall better deal than just rocking the 7%, the full.
Depends. That's the whole point. That's what I was trying to get at. So I guess my point is the further we're, here,
That's.
it's a steep, right?
Yeah.
And so I was thinking about this the other day, because if I thought rates are going to 3%, then maybe it's a different story. But I think the closer we get to that 5.5, the magic number is 5.5. And the closer we get to there and the cheaper we can make it work, fine. But again, like you said, I don't know if I want to pay a permanent buy down at 7.25. I think I might be better off doing the temporary buy down
Just seeing
because
what-
now, I mean, yeah, unless we get it closer to like this.
Okay,
I might be beating your slide, but what would take place if you refi the year after you did the temporary buy down and that leftover money?
Yeah, it reduces the loan amount. So when so if there's 10,000 left over on this account, your loan balance reduced by 10,000. You never lose it. So you either use it or it goes to zero, but you never lose it.
But if you did the permanent buy down, it's gone.
Correct.
yes.
So that's the downside to both of them, right? So I think, to me, again, the concept was, the more I thought about this, no, I was sober when I did this, right? So it was, but I guess the closer, as long as the spread between the 5.5 and 6.5, the closer I can get to that, and on the permanent buy now, I'll probably take it. It's the one we get way out of whack when we're like right now, where we're like 7.25 to get to 5.5, it's just too much. I just think that as a sell from a buyer's perspective, I'm willing to make that jump knowing I got these lower payments, right? The trick is I gotta convince the buyer that, hey, if rates do come down, we'll refinance you. The challenge is they don't come down and they get the payment back up, right? I gotta think in this market, we're gonna work our way back down. It's just a matter of when. But again, we can always refinance if they come down. They don't come down that far, then after the 2 years, your rates instead of being 7.25, 7.75, 6.75, then maybe we'll deal with it then. But these are good questions that people ask, right? So it's just to give them the information, the knowledge, so they can figure it out. But again, the farther we away from here, I think the temporary buy down becomes more of an option than would be, when we get closer to this. That makes sense? I mean, do you agree with that? I don't know, I mean,
So in a theory, if we had buyers, everybody wants to buy the brand new shiny home, but if you could kind of say, look, if you go with one of these programs, you could get a home that's been on the market for a little bit. Get them, the seller, to finance the
Mhm.
buy down.
Mhm. Yeah.
And then that way, the house has been on the market for, but it's not selling, the seller's more real,
well,
say,
especially in this market, they are, I mean, I talked to a guy the other day and he's like, yeah, I want to buy, he was buying this, $1.5 million or $2 million home. And I said, so how much do you have in your brokerage account? He goes, I used to have 500, I got 250. You know what I mean? That's, I mean, if you have buyers, and I have other buyers who are trying to buy a house too, but all their money's in the checking and savings account, they're fine. You know what I mean? They haven't lost anything. I mean, I guess maybe the other retirement accounts and everything else, but they're not. I'm like, those are the people I'm like, you need to buy now because you're gonna get a great deal at some point because seller's gonna be freaked out. So that's the idea. So you're right. So and then you look at these new construction deals, right? How does new construction work? They do the exact same thing. When you see those advertisements, hey, 5.25% or whatever, they're doing those reductions, and they can do it. You can do a 2-1. That I showed you was a 2-1 buy down. You can make this a 1-0 buy down for the first year. You can make it 1% and start off at 6.25%. It'll only cost you $6,000. Maybe that's something moving at, right? Or you can do a 3-2-1. So for the first year, it'd be 3% lower, 2% and 1%, so significantly more. But that's what builders do. Builders are taking it or using those costs, keeping the price appreciation where it is, and giving them on the backside of these lower payments. And so that's the buy side, right? And then here's the sell side, right? So the sell side is if I'm selling my house and I've got a listing and and I know what's going on in the marketplace, I need to be ahead of it, right? What can I do to get the home sold? Create it, make it look like new construction in a lot of ways. So part of it's the marketing of it. And this looks like I wrote this on the back of a napkin, but basically it's the same thing. We talk about a 2-1 buy down strategy. So your seller has to understand that. So I guess my point is the more you understand that, then you talk to your seller about, hey, it's been sitting on the market for 2 weeks, 3 weeks. Hey, instead of having a massive price reduction, let's just try to drop it. We can use 20 grand and really create payment affordability for a lot of folks and not have us drop the price a ton. So you still have some price, price, what's the word I'm looking for? Not appreciation, but price integrity, right? On that. So the idea is we can create marketing stuff. I can create flyers. We can do an open house together. We can talk about how to make a payment affordability strategy. So you make the seller clear that, hey, we can get way more perceived value by doing these temporary buy downs or permanent buy down than just reducing the purchase price. Okay. And so then we can, build into a marketing plan. We can make it part of your negotiation. You can even list it and say, look, we're going to offer 20,000 to a temporary buy down, but whatever you want to do, and that kind of thing, and then you can partner with a mortgage pro. That's the idea. So, but that's the idea. I mean, you know what I mean? So just in these markets and these times, you have to you really got to be ahead of the game. And I think knowing I know these been around for 100 years, so this is nothing new. But the idea is to thoroughly understand it so you can explain it to your seller, explain it to your buyer. It's a super huge thing that'll separate you from other realtors and stuff like that. And you can save the client money, right? Hey, let's just drop it 100 grand. Whoa. Why don't we just drop it 20? Let's use 20 and keep the price the same, see what happens. That kind of thing. Or do a combination of both. I don't know. But that's the idea. The other part too is I want to show you is that we have these down payment programs too. So if you're looking at a payment affordability, we have the down payment assistance from the state. So you can get 3%, 4%, or 5% in down payment assistance on that, which is helpful, right? Interest rate's going to be slightly higher because you're using a down payment assistance program, which means the first mortgage, in other words, if you do a down payment assistance of say 4%, you're buying the house at 100%, right? 100% purchase price. Your mortgage would be 97%, and you would get a loan from the state for either 3% or 4% or 5%. So it's a first and second mortgage. There's no interest on the second mortgage. It just has to be paid when you sell the house or after 30 years. Okay. The other one, which is really cool, is the Covenant Down Payment Assistance Program. Same kind of concept, but you get 20% down. No interest. Sweet deal, okay? So those are the ones that I talk about a lot, sometimes the payment affordability. I don't have the down, but I have the income. Okay? So these are really cool programs. So, and then I want to show you this. So in King County, King, Pierce, and Snohomish, you could do 0% down up to 806,500. Okay, so that's the purchase. So that's your maximum loan amount. So you could do 0% as a loan amount up to 806,500 theoretically. Okay. 3% down, you can do 806,500 too. That makes sense what I'm saying? So this is the loan amount. Or you take 806 divided by 97%, and that's your purchase price. Okay. FHA, you go to 1,037,000. 5% down, 1,030,000. 10%, 1,037,000. 20%. So in other words, this is the line between jumbo and non-jumbo. I can do up to 5% down up to 1,037,000. Now, if I want to get crazy and do 2 units and buy like a duplex, that conforming loan limit goes up to 1.3 million as a loan amount. If I buy a 3-unit property, it goes to 1.6. If I want to buy a 4-unit, I get almost $2 million on a conforming loan. And the guidelines are easier and easier to approve. Okay, just want to let you know. 1 unit, 5% down, 1,037,000. Hey, I want to buy a 3-unit, live in one, rent out the other 2. I can go up to 1.6 million as a loan amount and still have the conforming guideline.
Can you get an FHA loan on a debt service loan?
No,
Okay, so if you can't.
you can't yet.
use the
You
income
can
to
buy,
rent.
so you can buy on a, you, put it this way, the programs I've talked about, that debt service coverage ratio, that's different than this. You can buy an FHA loan and live in 1 unit and have the other 3 units rented. Okay, and they have, you can approve that way, it just has the cash flow. Okay. Conforming loan, you can do the same thing too.
So you gotta pre-qualify with these, where the debt service use that.
Well, the debt service one's for non-owner occupied.
Yeah.
Total rental property, I'm not living in it, no nothing. Okay. But these will have lower rates than the debt service coverage ratio loans. Okay. Cool. So let me show you my mortgage superpower. I gotta highlight myself here. Okay. So on your sheet, I showed you this. Did I give that one to you? It's on the back. Yep, yeah, it's on that. You're good. So this is a real life scenario, okay? I just want to show you, this is what we do for payment affordability. So what I'm looking at, this is couple, okay? They make about $8,000 a month. And they've been renting for 20 years. Agent met him at they work at QFC. Work at QFC, checker, and the other one is florist, the floral manager, whatever. Yeah, good. So together they make about 96,000. But here's their debts. They got a car payment at 984. Yeah. So they have about $3,400 a month in debts. So they want to buy a house. Okay. Should have bought the car later. But
$2,984 payments.
yeah, 52,000. I used to work for Ford Motor Company, so I understand it.
Wow.
So how does this work? Because you have the debt to income ratio. Okay, your maximum debt to income ratio can't be more than say 50% of your gross monthly income. $4,000, right? Yeah. So what do? I'm like, shit. I met her, like in your mind, like I got to figure this out. So what can I do? So interesting part about it was I was looking at an FHA loan. Okay. And I don't know if I didn't print this out for you. It's on the back.
It's on there.
Yeah. So what I did was, all right, what can I do? If I do an FHA loan, we do a down payment assistance program. The piece is that mom said they can give him 75,000. Okay. Good, thanks, Mom. Appreciate it, right? For the mortgage. So if I do a $500,000 loan, you can do an FHA loan because the credit score is just okay, but not great enough. You're better off doing an FHA loan. So an FHA loan on your sheet, you'll see it 3.5% is a down payment. They charge an upfront fee. FHA charges 1.75% of the loan amount upfront. They're gonna roll $8,400 into the loan just off the beginning of it on an FHA loan. Interest rate 6.625 because you're going through the state. Payments $30.91. You got to charge a 1% origination fee, monthly mortgage insurance, taxes, home insurance. Your total payment's $37.47. Okay, but I gotta have their debt income ratio is 4,000 is my maximum number. So they do a down payment assistance of 19,300. So the payment's $37.47, 19,300. Then I'm thinking, well, why don't we get mom to pay off the car? And I gotta have you pay off credit card too. Right? If I do that, I need you to bring in $75,000. And you're at 4893, maybe that'll work. Okay. But mom doesn't want to pay. Does she really want to pay off the debt? Don't tell mom, we tell mom what the closing costs are. In the house, right? I'm sure she'll figure it out. But mom's gonna live with them too, so she might be more willing to do that. So then I noticed the last name is Hispanic. And just so covenant loan programs, you want to protect the classes, you might be able to qualify for this down payment assistance program. If you can show that you lived in Washington prior to 1968, the family, the mom and dad. So I asked him, I said, hey, have you lived in Washington since 1968? He goes, well, my granddad did. Oh, okay, all right, let's see what we got. Well, turns out, so then this is the interesting part of the covenant program. We learn all these other things that you normally would never ask. Because it's a specialty program, we're able to ask those questions and that's how they qualify. So I get the birth certificates for grandmother. Grandma was born in a town in Texas across the border from Mexico. Okay, in 1956. Well, okay. So when did you move to and then she goes, well, we moved to Washington when I was a kid. Okay. So then, and my parents finally bought their house. And so when did they buy their house? And so I think it was in the 80s. Doesn't go back far enough, right? Because the birth certificate would be the one I would use, but it's not from Washington. So what happens, they would come up every summer and work in the fields, the wheat fields in Eastern Washington. So I'm like, well, they gave me a marriage certificate for parents in 1965. The state will not take that as part of where you're living, or a marriage certificate doesn't count. So I'm thinking, like, oh, church, is there some christening? What do you got? Well, it turns out, I didn't know this, but on the death certificates, and on all the birth certificates, it doesn't show race. It's just for them, it's white. And then on the death certificate of the grandfather, he died at 99, working fields. I mean, this is a tough life. So 99, and on the death certificate, it shows his race, which ties everything together. It shows the year that he was born, obviously, where he died, and on the state of Washington, which is really cool, it shows you the address of where he lived. And on the birth certificate, it says he lived there for 50 years. Now I've got it back to 1967. Okay. So now, let's go to covenant. Okay. So now I can do the same deal, but now I can do a 20% down payment, lower the monthly payment each month because I'm only doing 20% down. So my loan amount, instead of being, 482, is now to 400,000. So I'm saving 82,000 bucks. I don't have this upfront mortgage insurance, and I don't have the monthly mortgage insurance. So now my payment goes to 33,078 bucks versus 3747. And we only need to pay off the closing costs, funds to close to pay off the car. Still got to do that. But now I got a 42% debt to income ratio. And they're more willing to take this higher payment because now the car's been paid off. And no credit card debt. So I guess on the back side of that, you can see now they only owe $297 in total debt. Boom. Payment affordability. That's what you do.
And 22 grand less cash.
Correct. So now they can buy something that's a little bit more fixed or whatever, you know what I mean? But again, the hard part is where are you gonna find something for 5? You know what I mean? That's the other part of it. But conservatively, if we didn't have the other money, there's no way we can make it work. So I agree. The first time I met him, I'm like, oof, that car payment's gonna be a doozy. But then mom said she could pay it. We can get him qualified for the covenant program, saving money. I don't know what we do.
And it paid closing.
You could. Yeah, because they're gonna get it. So here's the downside. So not a downside, but you do these down payment assistance, so you're underwater on the house. So this one, you're underwater by 19,000 because you've got a first mortgage and you got that second. The second over here, with the covenant program, they'll roll in all the closing costs into the down payment assistance, where they won't on a convention, on a non-covenant program. So the covenant program says we will do the 20%, all your closing costs, all the prepaids, everything into the loan. If you want to pay points, you can roll that into the loan too, or into the down payment. So their down payment assistance is about 116, but they really only bring in no down. They're just paying off the car. Great program.
Are there restrictions on that covenant thing?
Parents have to be born prior to 1960. You have to have show that your parents lived in Washington prior to 1968. You have to be a first-time home buyer. Cannot, if you've already bought a home before, you can't qualify for this program. And the biggest one of all is you have to be part of the protected class, which is African American, Hispanic, Pacific Islander, Native American. It's another one that's
Asian.
Yeah, but I think it has to be like Filipino or something like that. Yeah,
Interesting.
yeah. I have them all. I should. I mean, but yeah. But yeah, I mean, it's a great program if you can get them into it. They did, and I wouldn't have asked until I just saw the last name, and I was like, why not?
If there's generationals of those ethnicities dating back to 1968 Washington State, like what's the other criteria? That like,
Those are those three. So number, if your parents, and so if you have family, your parents lived here prior to 1968.
yes,
Okay, are you a first-time home buyer?
yes,
Okay, and are you one of the protected classes?
yes.
Yeah, then you
That's
would
it?
qualify.
Yep, you qualify.
You would qualify for the down payment assistance program, but you still have to qualify for
Yeah.
the underwriting part of it, right? But that gets you into the game that you might be able to do that. So the cool part is, the thing is I got the uncle's birth certificate. So this is the buyer's mom's brother, right, his uncle. I got his birth certificate, because on the birth certificate, it showed when he was born. And I was like, well, maybe we can try that as a place to show that his parents lived prior to 1968 in Washington. But when I got the death certificate, it trumped all that. So now, if the brother wants to buy a house, I got to tie it up, right? I got the grandfather. He's lived in Washington prior to 1968. Got the brother's birth certificate or the uncle's birth certificate. As long as he wants to buy something and qualify, then you qualify for this program.
Crazy.
So
Got
just the
one
more
last-
you.
Got
yeah.
one last week.
So once you get the family member, they'll start talking. They're like, hey, I got this great deal. Now, the challenge I've run into is that a lot of family members aren't qualifiable yet because they just didn't know they could do it. So the thing is, you might take them a year or two, but once they know it's possible, then we get them set up.
I just learned something today.
Shocker. I'm glad I did my job.
Yeah,
That kind of makes, there's a lot, and Eric, there's a ton that you're like, what is going on?
Oh, I was gonna talk to you after.
Yeah, but I mean,
I was saying, I need
but
some, like,
same
something I
thing.
can actually not run.
Same thing with
but-
you, Cal. There's a lot going on here, but you get the idea, right? So I guess my point is creating payment affordability with different strategies. But also now we can combine this with, if we want to do a 2-1 buy down, we could do it on this. If we wanted, and then we can talk about different strategies with the payment affordability and do those temporary buy downs or full buy downs and combine it with this. So that's the idea. So I think my thing is, like, we've all known about this on the buy side, but I really think for you guys on the listing side, it could create a ton of affordability from your seller and then like say, hey, look, market's tough, I get it. But here's our strategy around that. Here's how we can save you money without really dropping the price right now. Let's try this first. We're still in the market, then we'll go to plan B. But
is there like max amounts for that covenant program, is there max loan amounts that you can?
yeah, say 806.
Yeah,
806 that, so here, show.
so 806,
806.
806.
that's the max.
That's
you can
maximum
utilize
loan
for
amount
that-
you can get.
For that program.
Correct, but the other part, I forgot to tell you this is the reference. You can't make more than 144 grand a year.
Okay.
Yep. So you're limited. So if you make more than 144, you may not
Per person.
Total.
total income for the house. So no, so. It's not household income, it's a personal loan. Right, so if I have a husband and wife, right, I want to buy, great, he makes 144,000. My wife makes 200,000. We won't put her on the loan. We can still use my 144.
Yeah.
There's other programs that will say whoever living in the house. Then they look at the whole they look at all income, even though they're not on the loan.
Yeah.
That's like your house key opportunities and these other things.
Get a nice little niche to carve out
Okay, for this,
for that covenant program.
that's what been hyping up. So yeah, I mean, I'm licensed you have to take the down payment assistance program, or you have to take the down payment assistance training. So you gotta take a class. So as a first time home buyer, I gotta take a class and you can do it online for like $50. Or you can do it in person. It's gotta be like 8 hours. But I know Levens, you can teach the class, right?
Yep.
Yep, I can teach the class. But you gotta have that for the certificate, so. Yeah, everyone coming in. It's a great way to educate, do stuff. Only downside it's 8 hours. On a Saturday, but that's the idea. To create that payment affordability program. So I guess more of my thing is talking about this with your seller. Maybe a good way to go at the beginning. If I can help in any way, if you want me to do any scenarios, so when you go in there. Or I would love to talk to your seller too, just because I think you don't really bring a lender into the seller, but these kind of strategies might make it a little bit clearer. Any questions?
It works.
Yeah.
Got a couple of them one.
Yeah.
Got houses.
Yeah, that's great. So let me do this. So is there anyone in the chat box? I probably totally ignored that. Okay. Where's the chat? Oh. So that's all I got. Almost like an hour. That's pretty good. Buddy, boss. That's right. That help though? Is that kind of interesting? Somewhat? Yeah. I'll hit on some of this tomorrow at the meeting too. So you can say. I know, but if you understand the temporary buy-down, that's the biggest one that people don't understand. Last month they did reverse mortgage. Missed that one, but we need, if you can, I talked about that one too. That's pretty good. Right? And I think that's all I got.
Thanks, Eric.
Yeah, thank you guys for showing up.
Can I get a few of your business cards?
Absolutely. Absolutely. What time is it? I gotta call it. Thanks for coming up, huh?
Thank you. No, I've literally never heard this. That's
Yeah.
I mean, there's probably not many people that fall in those categories, but it's good to know that stuff.
Yeah, that's what I'm saying. So it comes in, yeah.
Well, if you get one and they start talking about their community,
That's the
and then
whole,
they're like, Andrew is the guy that knows about this stuff. That's cool.
Yeah.
Thank you.
yeah, I'll give you more detail if you want about it.
Yeah,
I didn't get a coffee. I'm gonna meet up and chat. Yeah, it's gonna look interesting guy. Where do you live?
Right here. Yeah.
Oh, okay, right here. They live in Colorado.
Sitting in the same.
That's why you get time on maybe next time.
Yeah, it was very. Yeah, I definitely need to do that because I've got a lot going, I'm trying to get in so I can get regular communication with all these communities.
Oh, for sure.
And then,
Yeah.
then we can do the second.
Yeah, because I was talking to my boss about it the other day, I have like, I would say a hammer, but we have the guru that does all the reverse markets for 20 some odd years. So I mean, he does so much, so it's kind of interesting talking to him about, hey, here's what's thinking of that kind of thing, so.
That's good.
Okay, all right, well, thanks for coming in, I appreciate it. All right, we're gonna chat about. I got 15 minutes.
Oh, that's
And then at that point, then I gotta call it over. I got some stuff going on at my place.
it's fine.
And the guys. And stuff, and you're supposed to come like 3 weeks ago. So yeah, well, thanks for coming.
You're still doing it.
Thanks, bud.
Oh, that was